What is carried interest? The way carried interest works is upon a event, which could be an IPO or an acquisition, the carried interest would be paid to the fund which is managing your investment. So in an SPV, special purpose vehicle, it's typically an LLC, usually in Delaware, but it could be anywhere. And that SPV invests in one asset and one asset only. That's why it's called a special purpose vehicle. It's not a fund that invests in lots of different things, just one thing. So you're not buying stock in the company, you're buying interest in the SPV which hold that asset. Stock in Databricks, Epic Games, or other companies. So in the case of carried interest, if let's say there's 20% carried interest, and let's say you invested at $100 a share. Let's say there's an IPO and you're going to get stock in your account because that's what happens at IPO. The 20% is going to be charged to you out of the profit, not out of the principal. So in this example, let's say you paid $100, the IPO is $200. Well, the difference between 200 and 100 is 100, and 20% of that is 20. So what would happen? The fund would retain 20% of that $100, which is $20 a share, and distribute the 80% or $80 a share plus the 100, so that you would actually get a distribution of $180 a share into your public stock account. And that's how carried interest works. So if you're looking at an SPV investment, you're going to see two numbers. Either it's going to say 0, 0, 1 and 20, 2 and 20, or that kind of thing. The first number is going to be your management fee. The second number is going to be your carried interest. So let's say it's a 0, 10. That means no management fee, 10% carried interest. The management fee is something that's charged annually, or usually calculated annually, sometimes paid monthly or quarterly, or or even annually. So that is going to be a fee that's charged to manage the fund. The carried interest is only a percent of the profit.